radio for a really great future. We're talking real money.
Dare I look? Let's see. schwab.com. Okay, then username and password. Click enter. And by the way, the phone number is 855-935-TALK. Oh, Tom.
Feeling better, are you?
I'm feeling so much better now, looking at my Schwab statement for the first time in almost the entire year. I see a little blip upward.
A light at the end of the proverbial tunnel?
So to speak, sir. I mean, okay, I'm still down year to date, but, well, no, wait. Yeah, I'm still down year to date, but not by nearly as much. What a miracle has occurred.
Well, we chalk it up to Christmas, but we're still a few weeks out from that miracle.
It's a Thanksgiving miracle. Thank you, ghosts of Christmas past, present, and future.
Let me give you a couple of numbers, see if that encourages you a little bit more.
Well, okay, I gave the best number of all, which is 855-935-TALK, 855-935-8255, where you can call us and rejoice with us in the return of stock market prices, at least temporarily. You have some numbers, though?
Speaking of,
do you have good numbers?
Temporarily, I mean, who thought we'd be all excited about the fact that inflation's only running at 6.5 or 7%? Oh, that's a real reason, but that's better than it's been. And with that, the Standard & Poor's 500 up almost 6% this week. For those of you playing along from home, that's the best week since June. I doubt you're paying attention to that, but
June of 2022.
June of this year, but it was the best day on Thursday, the best day since 2020. By the way, the NASDAQ was up 8%. Bonds had a good day too. I mean, everything kind of went up because the idea here is that we're not going to have to raise rates. Don and I don't do this. The Federal Reserve.
Yeah, we don't get to raise rates.
So they're not going to have to raise them as much. By the way, you mentioned year to date. It's kind of interesting. The Standard & Poor's 500 is still down 15%, but a globally diversified portfolio is only down 10%. And how about this? There's a reason we tell you to own U.S. small cap value stocks.
Yeah.
They are basically breaking even now for the year, down 0.2%. So you got to have some of those in that portfolio.
Wow. And that AVGE that I bought a few weeks ago, man.
Yeah, how's that done?
That's up 12% since I bought it.
You got to be careful because I run into so many people I talk to off the air who say, Don said the AV, so I ran out and bought it. Well, is it part of your portfolio? It doesn't matter. It sounds pretty good. I got to have some of that.
I know. I hate that. I hate that. Yeah. Okay, I shouldn't have said that, but I do have it as part of a portfolio that has a little more international in it. I overweighted international. It's got some bonds. They have not done well this year.
Nope.
I overweight small and value even more than Avantis does. So it's part of an overall portfolio scheme.
That's the part that people forget somehow, though, because they've been asking me about, well, should I own VBR and AVUV? Two U.S. small cap value funds? Like, well, no, those are the same asset class. And if you're already diversified into international, why do you need to add another one? You got to have a real portfolio. You're not just adding things on as we talk about them or anyone else does.
Yeah, if you listen to the banter about individual stocks on the radio or on television or individual mutual funds here on Talking Real Money, you are going to end up with that dreaded disease that afflicts way too many investors. Ladies and gentlemen, this is the time of year that hodgepodgeitis spreads like the plague.
I think it's spending more time inside, spending more time on your computer screen,
exactly,
and listening to more stuff.
You're going to catch hodgepodgeitis. That's why we say you have to have a plan. You don't go and you don't buy individual stocks. You don't like look what happened to Amazon.
We're going to talk about that next hour. So, no, we're talking about that this hour. You want to do that now?
We don't have
Anytime.
Or
Amazon,
or the music came up and bailed you out of following the cue.
Mr. Lack of Preparation. Yeah, I'm ready to go.
It's no okay. Problem. No cue boy. At least you have hair, so we won't call you a cue ball. 855-935-TALK is our number. Give us a call, please.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
You wanted me to say something bad about Amazon, but I decided not to because I want my Christmas deliveries on time. You go right ahead because your packages may be stuck somewhere else. So go at it, man.
No. We were just going to talk about how far their stock has fallen.
Well, it's
and the whole idea of buying one stock.
$1 trillion, first company ever to lose $1 trillion in market capitalization. The first. Congratulations.
Okay, first company.
Yeah.
Right. I mean, there've been cryptocurrencies that have done that without breaking a sweat, like Bitcoin. Bitcoin's done that. They've done that.
FTX.
855 FT. They had a coin that didn't have the Bitcoin value. Yeah. We'll talk about that another time.
Yes,
we will tear into crypto at some point in the future. Yeah. I promise you. Who can avoid doing this? 855-935-TALK is our phone number. 855-935-8255. Defenders of crypto, hey, you can always call us too. We will certainly listen to you. We might argue with you, but we will definitely listen to you. And we got a call waiting. Jeff, you're up. Welcome to Talking Real Money.
Hi, thank you very much for taking my call. Can you hear me?
Yes, sir, we can.
Hi. Okay. Me and my wife are in our mid-60s. Okay. We are considering retirement, and we know how much we are going to get in retirement because we get a letter in the mail that tells us how much. That letter also tells us how much we will receive if we delay our retirement for a few years. But that is based upon the assumption that we are continuing to work and continuing to contribute during those years. How can I figure out how much our Social Security will go up if we quit and live on assets for a few years before we officially retire?
Well, there's two parts to that. The first
do you
part
understand
is
what I'm asking?
Oh, yeah, absolutely.
Yes, we do.
Absolutely.
There's two parts. And part one is the aspect of waiting. The longer you wait, the bigger the benefit is being, because it's an actuarial table. If you wait till age, I'll give you an example. Mine, if I take it 67, is about $3,100 a month. If I wait till age 70, it's $4,100 a month. Considerable. So that's one factor. The other factor that you're kind of talking about is if you quit, the Social Security assumes that you will continue to work until your full retirement age at the salary you're at today. It makes that assumption when it calculates your benefit. But remember, it also looks at 35 years of experience. So if it's a couple of years at the end where you decide I don't want to do this anymore, it's not going to be a huge change to that benefit other than waiting for those years to come up because the benefit gets bigger.
Yeah, and the other thing is if you've been a high earner, those high earning quarters are going to, they will have already pushed you up near the maximum benefit anyway. But the change is very, very tiny. And again, they assume right up to FRA. Are you planning to retire prior to full retirement age? Or are you going to wait till full retirement age?
By perhaps a year or two. Actually, my wife will probably retire before her full. She's a year younger than I am. So I think I'm going to stay in until I'm 66 or 67. She will probably retire when she's 65.
You are hardly going to see that number change. That number,
it's not going to change.
It's going to change by maybe dollars.
And I will say this: it will make a lot of sense.
So,
assuming you live a little while, Jeff, it's going to make a lot of sense to take the money out of the money you have saved and let the benefit grow at least a year or two, as Don said, at least till full retirement age before you start drawing that. That will make sense.
Yeah, except in my case where I really do expect I will not make it into my 80s, so I'm going to start taking it tomorrow. I'm just going to file.
I already shorted.
I made it way past where I thought I'd make it. So.
Okay. Well, listen. I want to make sure I understand what it is that you're saying. It sounds okay. Assuming that I retire at my full retirement age. Okay,
correct.
Then it doesn't really make any sense for me to just live on savings until I'm 70 and then begin.
It totally does. It totally does. What we're saying is if you make it all the way to FRA, then they don't calculate you making that same money from that point forward.
It totally makes sense because you're getting an 8% a year raise on the benefit.
Then it's much.
If you quit beforehand, there'll be
okay, but if it won't be much of a change at all.
Correct, sir.
There's two parts to what you're saying to be very careful about. Quitting is one thing because, yes, that's going to affect your benefit, but in a very minor way. When you claim Social Security, that's a big difference because that is growing month by month at a rate of 8% a year. So that is a big difference. And that, yes, Jeff, makes sense probably to wait till age 70 to collect the benefit if you expect to live till 80.
But go ahead and retire early.
And take the money other one. You can retire anytime you like. You just don't claim the benefit. That's all.
Okay. No, wait a minute. Okay. But
what you see right now,
what you're not contributing anymore.
But that doesn't matter. As a matter of fact, I'm just going to go in and change my future annual salary to 0 and calculate my future. Right now, if I retired today, I'd get about same as Tom, $3,100. If I waited until 70, I would get $4,100. Now I
want more.
I'm in Social Security right now
without working.
Yeah, I'm going to put in 0 as my future salary. All right, you ready?
Okay.
I put in 0 as my future salary. I'm 66 years old. My current benefit will not change at all. My delayed benefit will drop from $4,060 to $3,900.
So $150 a month. That's
right.
That's real money. The more important part.
So
frankly,
in other words,
waiting.
it does make sense to live on savings for a few years.
Oh,
well, no. Okay,
it
you're
does
missing.
make sense then, doesn't it?
Missing
no, Tom.
Yes.
I think
in a general sense. Go
yeah.
ahead.
If you are going to you want your retirement benefit to grow at 8% for the next 3 or 4 years,
a year,
8% a year, then you live off of other money.
Correct.
And it is not. This is not an exact. Right. Okay, we're. This is not an exact science. The problem is we are guessing about your longevity.
Yeah, you got to know that you're going to live those 10 years.
Right.
After you claim it.
Right.
So this is not an exact game, but it does reduce your benefit, but it doesn't reduce it dramatically because remember, like let's say your future salary. They anticipated your future salary at $100,000 a year. So your benefit now, see, my salary is at a much higher number because the past 2 years of my life, I've made a lot of money. So my salary was really high.
Okay.
If your current salary is $100,000, you keep working until you're 70, your delayed benefit would be almost $4,000, $3,981. If your future annual salary, very few people's future declines to 0. So let's just say it goes down to $20,000. Your future will be just $38.93 or $7 difference. So,
and by the way, who's the wisecracker? Some wisecracker just texted me and said they check with Social Security. They do not consider Don's and myself occupation to be work. So we may not.
We may not get a benefit at all. So again, it's not easy. But if you do stop at 66 years old, 65 years old, yeah, your benefit at age 70 will be reduced a little bit. If you make a lot of money, it might be reduced $100
a month.
A month.
Okay,
but it's not going to make a huge difference. And that difference between $3,000 and $3,900 a month. That's huge. That's a lot of extra money every month, particularly if you live into your 90s like so many healthy people do these days.
Tom and Don are talking real.
I think I got it. Thank you.
For your real life and real future, Tom and Don are talking real money. Social
Security can be so confusing, and it's kind of silly that everything that has anything to do with the government is massively convoluted. Taxes,
we just did Medicare,
week. Social Security, all of these things are just so convoluted and complicated. They make your head spin. I don't blame you for being confused. We are confused. We deal with it. It's a lot, man. It's still frustratingly confusing. 855-935-TALK. That is our phone number. And Robert, Ryan, thanks for waiting. Welcome to Talking Real Money.
Hi, can you hear me?
Yes, sir.
Hey, Long-time listener. Thank you for having me on. I'm 47, retired from the military. I draw VA, and I work for the federal government now as a GS-level employee. I've been contributing to my thrift savings plan now for about 15 years, and it's right around 100K. So doing okay with it. Probably could do better. But right when the Ukraine stuff kicked off, I put everything into the G Fund, which is just the government kind of locks it down. It doesn't get affected by the stock market. And I'm kind of wondering when to reinvest that. I'm glad I did because everything's down at least 20%.
Oh, Ryan, we're both moaning. We're both moaning.
Ryan. First of all, thank you for your service to our country.
Yeah, but we're still going to moan at you.
Yeah, you're 47. You're not 97. This is money you're continuing to grow. You're
a market timer, Ryan.
Yeah, this is really okay.
Yeah.
Back to the basics here. At 47, you're going to work how many more years, roughly?
Oh, geez, a while.
Yeah, 20.
Okay.
Yeah, 15, 20 more years probably at least.
Let's just say 15. I mean, you should be, I'd say, no less than 70% in stocks and 30% in the wonderful aforementioned G Fund that, as you said, locks down. It owns bonds that nobody else can buy.
Right.
But the rest of the other 70% of your money should be invested in the 3 stock funds that we think are pretty good funds. They have a small cap fund, a U.S. fund, and an international fund. It's pretty diversified, pretty low cost.
Very low cost.
Yeah, it's where I've been for. It's where I've been for a long time. It's
but here's the problem: you did, and there's an old saying about timing the market that you have to get it right, not once but twice. You got lucky and got it right once. Do you know? Apparently, you don't know because you're asking us. Where's the bottom? Was it last week? I don't know.
Well, and that's what I'm getting at is because it's dropped dramatically, and I'm like, well, I'm not doing anything with it in G Fund. It's not buying stocks at low prices or anything. It's just sitting there. And
right, and so bear in mind,
some advice.
You are in the accumulation stage, Ryan. You are adding money to your plan every single month. So the smart move would have been to leave, even though you did well, past tense. You got lucky. You timed it right. Very few people do. Remember when the Iraq War started, the day it started, the stock market went up like 10% or something. It was wasn't that big, but it went way up, and it didn't stop. So those people who got out then, and my wife was one of them, because she said the war is going to kill the market, they ended up being unlucky. You got lucky. So,
and your asset allocation should be about you, not about wars, not about inflation, not about the economy, not about interest rates. The next crisis will come along, be it as it may. You have a portfolio that is designed for your growth for the next 15 or 20 years. Good days and bad days are going to come along. We don't know when those will be, as Don said.
So what I would do is I would tell you that whether or not the market falls further, and I want to qualify this comment, you should get back to your proper allocation for your risk tolerance immediately, and then continue to make contributions based on that allocation for the rest of your earning life. Because every time, if you had continued to do this, every time you put money in, you were buying stocks on sale, progressively cheaper every paycheck, which you didn't do. So you gave up some of that. I don't know what your net would have been, but you gave up some of the good stuff for the other good stuff. You know, you got out.
Think of the day you missed last Thursday.
Yeah.
My goodness, we 5% in one day.
I know.
Come on.
That's why I'm calling. That's why I'm calling.
Get back in, Ryan. Thank you. You know it's the right thing to do.
Thank you.
Take care. 855-935-TALK is our phone number. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
And it's something we do almost every day. Either on a radio show like this one that becomes a podcast, or on a podcast that you can listen to anywhere in the world. Anywhere in the world you can listen to our podcast.
I got a question from a guy in Dublin.
We've got a listener. We know we have listeners in Ireland and UK.
Yeah. Well, Dublin, turns out Dublin is in Ireland.
Not Dublin. Well, could have been Dublin, Ohio.
Could have been Dublin, California, too. But this is Dublin, Ireland. He says the weather's kind of between Washington's and Florida's.
Closer to Washington, I'm thinking.
Yeah, I was going to say, anyway.
I don't know for sure, but, similar latitude to you guys. 855-935-TALK is our telephone number, and Charles. No, gosh, I'm so confused. I keep seeing Robert. But Charles, you're up. Welcome to the show. I need remedial viewing.
Hey, guys. Thank you.
Hey.
What's up?
Thank you for taking my call. Tom has helped me one-on-one and has not tried to sell me anything. I really appreciate that.
Tom, I told you, start selling. Darn it. Jeez.
I have a leftover. I think it's like yeah, go ahead.
I'm sorry. I was going to say, when I find some free help from guys that I trust, I tend to leech on and just take all the help that I can get. So, we told our kids that they had to pay for half of a car. Their first car, we would pay for half. One of them, the 17-year-old, she gave us $2,000. And then I remembered I told them at one time I would never take their money. So I decided to put it into a custodial account for her. And I'm wondering if you can recommend an ETF. It's money she's earned, so she can invest it into a like I said, a custodial account. I'm assuming not an ETF. I'm sorry. I'm assuming a mutual fund. Or
it could be either, by the way. And by the way,
$2,000. I figure it'll stay there for a couple of years.
It could be either one. And how well does a half of a car drive? I've had some bad cars, but half a car?
Okay, you don't. Please don't laugh. Don't laugh. You just encourage it. Please don't. I know that was a polite. That was a polite titter. That was a polite titter. Don't do it. Really, it's kind of like feeding the bears in your neighborhood. They just come back for more. Don't do it.
One
Dangerous.
ETF for a young person.
Okay, she's 17 years old.
Yeah.
Correct.
What do you pick?
And this is going to be for the car. Is that right?
No. The car's already purchased. This, I'm hoping she'll just keep in there until she's like 60.
Oh! That changes the whole world.
Things.
Wait, she earned this money?
Long term, yeah.
She earned this money?
Yeah, she earned it at working, and so I'm going to invest it in a custodial account for her. And we're not even going to tell her about it.
No.
20,
Ready?
Maybe.
Tom, sing along with me. ROTHIRA.
Roth, Mr. Roth.
Yeah, she needs a Roth.
Yeah.
Oh my gosh.
Okay, a Roth, not a custodial.
Roth IRA.
She needs a Roth IRA, and then you put it into something like VT or AVGE.
AVGE would be great. The Roth before I think it still would have to be a custodial Roth IRA because I have a custodial Roth IRA.
Yeah, because she's a minor, but it's a Roth.
Yeah, she's a minor. It's a Roth because that allows if it truly could be held onto for retirement. Wow, you're going to get like 40 odd years of tax-free growth, completely different than being in a custodial account where when she sells something there, she's going to have to pay the capital gains tax on it. So you would much prefer that.
Oh, the excitement.
And did you get Don's exchange traded fund suggestion?
The
VT or AVGE.
I lost the letters.
V is in Victory, T is in Thomas.
Thinking.
Yeah, or
well, VT is a little less aggressive. It's the total market, and the AVGE is the Avantis. What's the all market?
All equity fund.
All equity fund, yeah, and it has U.S. and international. It has a tilt towards small, which we think long-term. I mean, long-term small cap stocks over the last 100 years have returned like 12% per year or something ridiculous.
2% more than large.
Yeah.
A year.
So,
So
I mean, if she did that because her full retirement age will be definitely 70.
90.
If she did, yeah. If she did that, just that. She didn't put any more money in at all, and she left that for the next 50 years until she's 67. You ready?
How much?
Almost $800,000 at 12% per year. Just the two.
Don't tell her about it until she's about 50.
She would never have to add another penny to get to $783,000. This is why it's so doing
All
it
right,
young.
I use the
Oh,
AVGE.
yeah, I think I'd do AVGE. It's more aggressive. She's young. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Oh, I forgot this. I wanted to sing the praises of Paxlovid.
This stuff works.
Oh, my gosh.
Yeah.
I mean, I took that stuff, and on the 5th day, I tested, and I had no COVID in my system. And right now, I feel the best I felt since before my surgery. I'm feeling.
Yeah,
I'm so happy.
Look like 6 months younger, maybe
6
maybe
months
7.
and an inch taller. 8. I literally am an inch taller.
Yeah, they stretched it out.
After the surgery, my wife went, "You look taller." And then I went to get in the car, and I hit my head.
I'm not sure if that has anything to do with height.
It never happened before. I guess I've been getting shorter as my spine collapsed, but now I'm taller and I'm happy. 855-935-TALK, 855-935-8255. We're happy when you're calling, as you have been today, so thank you. And Ed, thank you for calling. Welcome to Talking Real Money.
Hey, guys.
Hey.
I appreciate it. I share a couple of things with you, Don. I'm here in Northwest Florida, and I also am recovering from a 4-level cervical fusion, so I'm out walking. About the only thing I can do right now. So.
I know. You can't turn your head to the left or right, but as long as you go forward, you're good. Don't make any turns.
And keep the brace on, right? The collar.
Yeah. Oh, man, yeah. Well, yeah. I am sorry to hear that you did
blinders
that.
On.
But it sure is miraculous surgery, because I feel so much better. Hope you do too.
Yeah, and I'm glad to hear that it didn't impact your voice either. You still got the great radio voice. So.
Thank you very much. Well, what can we do for you today, sir, as you're out strolling?
I've got a couple of quick questions. I was deciding on which one to ask. If you run out of time, then we can kill one of them. But I think either one of them will be pretty quick.
Well, we have time for both.
I've been kind of curious. Okay, great. So due to circumstances, selling a couple houses and buying a house, I ended up with basically financed my whole house at 2.5% interest, and decided to keep the cash that I had to which I could have paid it off with. And so I've been kind of holding it because for the last year, as you both know well, neither stocks nor bonds have been very. I've been interested in investing in either one of those. So, but I did decide to do some use Treasury Direct, and I've been getting some short-term T-bills, and I haven't heard anybody talking about that. And I'm getting 4% interest guaranteed. With about as safe as you can be, right? 3 to 4% interest.
Yeah.
Depending on how long.
Well, Ed, let me just tell you that Tom over there is shaking his head side to side. Tom was just shaking his head because you're doing. Go ahead, Tom. You explain your head shaking.
This is no different than the first call of the day that was talking about market timing. This is simply time. In other words, if this is long-term money, Ed, money that you are not going to use in the next, I'd say 1 to 3 years. Okay, 4 years. It should be invested at your asset allocation, your growth rate. So in other words, if it is you're going to stop and grow for the next 10 years, you should be what percentage in stocks and what percentage in bonds. You shouldn't be paying attention to this short-term interest rate.
What he's saying, Ed, is that instead of saying I am not going to invest because of X or Y, in this case, X is the stock market has been down and Y is the bond market has been down, instead of not investing, have you ever created an investment plan, a portfolio plan, how much risk you need to take, what you want this money to do for you, how much you need in the future? Have you sat down and done that?
Yeah, so I haven't, and I didn't want to get into a lot of details. I do have other money with Vanguard, a lesser amount because they're, some that self-managed, some that they're managing, and then some with Fidelity also. So but to answer your question, I haven't specifically, looked at the total picture. That's something me and my wife are
you need to do.
Looking at is I'm looking at retiring in a couple of years here. So yeah,
you got to do it if you're retiring in a couple of years. Go ahead.
Oh yeah. But related to that, I was looking at Fidelity and Vanguard for something that is tied to Treasuries that's going to get some decent rate. I can understand they're not going to get 4 or 5% right now because just now the interest rates are going up and the short-term yield Treasuries are at higher rates. But there's nothing out there that that again just that I can put a portion of my portfolio in, that's maybe tied to those short-term Treasuries that maybe I could get something like a 2% or
yeah. Okay, here's the deal.
Like
again, we're going back.
We're
going. Well, one of the reasons why that is, one of the biggest reasons why that is because the funds have old bonds. A short-term Treasury bond fund is going to have bonds that they bought when rates were much, much lower that haven't matured out yet. So their average rate across the portfolio is going to be lower than a bond you would just buy on your own today. However, the bigger issue still applies, Ed, and that is you're looking to build a portfolio in bits and pieces. This is why I came up with the term hodgepodge portfolio. You have one because people are always buying based on what I feel today or what my expectations are for tomorrow. But it's all based on gut, and you can't invest based on your gut or your feelings or what you think is going to happen. You don't know the future.
Well, yeah, but I know that if a year ago I would have taken $200,000 and dumped it in any of those stock market funds or any distribution, I would have lost money.
Okay, so let me ask you.
You might be missing the next 10% run. Started on Thursday, by the way, too. You have no idea what's coming next, nor do Don and I. Yeah,
you got lucky. See, we all like to think we're smart, that we knew better than the market. But the fact of the matter is you didn't know, you thought, you believed, you conjectured, you didn't know. Your move turned out to be brilliant, but we confuse brilliance with intelligence. You got really lucky. Now that you've gotten lucky, what if the new market run started on last Monday? You're out. When are you going to get in?
Right. It could be something I'm missing, but I do know that interest rates are going to go up, right?
No, you don't know that.
So
how do you know that?
T-bills are going to go up.
How do you know that?
Because of what the Fed's doing,
but the Fed does not.
Who knows?
The Fed does not. Wait, see, this is where we all get this wrong. The Fed does not impact T-bill rates at all. The market impacts T-bill rates, and if the Fed raises rates again, let's say next month, and the market says we think this is over, T-bill rates will start falling.
Yeah, and you saw that again on Thursday and into Friday a bit too. So you're making a big bet that is not a good one. I wouldn't do that. Don's right. Short-term money's one thing, but not long-term, not for your future.
We all have to stop thinking we know things just because because they're happening right now. We don't know anything about the future. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
We told you you can talk to Tom and he won't try to sell you anything. That guy said it. Yeah. Now wait. Had the Rivian been delivered on time, he might have tried to sell you an old Honda.
True enough. Fair enough. No, my daughter's got that picked out for herself, so no, that wouldn't work either. So.
Well, the timing's going to work out really well for her on the Rivian delivery, isn't it?
Assuming it ever shows up. So the point of the matter is, get some professional help. It happens that you may need it. Because all the people we talked to so far in the program, well, they kind of need it because they got a variety of things and they're not looking at their future properly. So get the help you need.
Are we that late getting out?
Online. Easy.
I'm looking at the clock. Are we late? Isn't it 55 or is it 56:50? I get so confused. We must have more time. So anyway, I'm a very confused person today. It's kind of been all over the place. Go to talkingrealmoney.com. That is a lovely, lovely place where all kinds of magical things happen. You can set up an appointment with Tom. You can listen to the podcast. You can watch our old video things that no one watches. And we don't do a live video show, by the way, for those of you who are thinking we do that. And also call 800-386-3004 or go to talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.